So good afternoon, everybody, and welcome to today's First Time Buyers webinar. My name is Claire Doyle, and I'm delighted to be with you here as Vice Chair of our ACA Professionals Committee. Our committee is dedicated to supporting our members from admission through to membership, through the professional journey to becoming an FCA. So whether you're newly qualified or you're a more seasoned ACA, we're here to support you with your development, with your CPD, your networking opportunities, regional connections with other societies, and a mixture of both online and in-person events, just like the one we're here today. Looking forward, we've got a really exciting lineup of events planned. So we have our table quiz that is happening on Friday the 11th of April with the Tax Institute and the Society of Young Solicitors, followed by our annual Pride Barbecue celebrations at the end of June. Now, let's take a moment to introduce today's speaker, Martina Hennessy. Martina is the Managing Director of Doddle, which is an award-winning mortgage brokerage in Ireland with over 20 years of experience in the financial service industry. She's passionate about helping first-time buyers navigate the home buying process. She's a frequent contributor to social media outlets, sharing her insights on mortgage trends, holds a Bachelor's of Commerce from UCD, is a chartered accountant with Chartered Accountants Ireland, and is also a qualified financial advisor. Today, Martina is going to take us through the home buying journey, covering multiple topics such as your mortgage application criteria, the available mortgage options out there, the kind of costs that you're going to entail, and the kind of supports that are out there from the government for first-time buyers. So if you have any questions, feel free to put these in the Q&A section, and we'll do our best to answer as many of these as we can. We're also going to be sharing the slides from today's sessions, so keep an eye on your inbox for these. Now I'm going to pass you over to Martina.
Claire, thank you so much, and thank you to the entire committee of ACA professionals. I really appreciate the opportunity to speak today. So thank you for the introduction. I think you've done it better than I could do myself, but Martina Hennessy is my name. I am a founder and owner of Doddle. So Doddle is a multi-agency intermediary. So we work with all major lenders and providers in Ireland. We have a team of 48 mortgage professionals, and we have been in operation looking to secure the best mortgages on the market for our clients for over 20 years. But Doddle itself has been in existence as a brand for 5 years. We have an online platform that allows you to securely and confidently and competently and transparently progress your mortgage right through from initial inquiry to completion. Our team of advisors at Doddle are there to support you throughout your mortgage journey. So just to kind of give you an insight as to what our role is within your mortgage process. I'm going to jump in straight away into, for anybody who's looking to take out a mortgage, the kind of key basic pillars of mortgage lending in Ireland, because I think once you know how a lender will assess your mortgage application, it's easy for you to then plan and put your bases in place so that you're going to make a successful application when you go about making a mortgage application. So many people will get their mortgage approval in principle right at the start so that they can understand how much they can borrow, what deposit they need, and to make sure that they're in a really strong position that if a property comes up that is of interest to them, that they're ready to go ahead and purchase that. So I'm going to go through each of those 3 pillars of mortgage lending: loan to income, loan to value, and a key point on mortgage lending, which is clear evidence of repayment capacity. So looking at what happens or how much you can borrow. When a bank is assessing a mortgage application, they assess based on criteria under central bank macroprudential lending rules. And what that really means is a bank is will allow you to borrow up to 4 times your allowable income as a first-time buyer, or 3.5 times your allowable income as a second-time buyer. I would say outside of these rules, the banks are allowed to apply exceptions to up to 20% of their book of business. So for first-time buyers, you can go above that 4 times income multiple up to 4.7 times, 5 times your income multiple. And for second-time buyers, you can look to get an exception to borrow up to 4.25% your income multiple. So all of those income multiples and figures to really bring it down to if you were to try and calculate what your own basis would be. So for any mortgage application, allowable income, and why I focus on allowable income as opposed to income is because banks all allow different amounts of your income to be taken into account. So they'll all take 100% of your gross basic income. They'll all take guaranteed car allowances into account, but some lenders will only take a portion of your variable income. So if you're someone who gets a bonus or overtime or commission, or you've any form of variable income, banks all differ in terms of their credit policy as to what they'll allow. So when you're looking at how much your allowable income is, it will very much depend on the different lenders, particularly if you have some variable income. Some of the lenders will allow 110% of gross basic income to be taken into account for young professional applicants. In some cases also, where you might have trainee contracts or contracts in general, we would very much make a case for our applicants with the mortgage lenders to show the sustainability of income and future potential earnings based on salary surveys, etc., just to really, really make sure we have a solid application going in for somebody who's on a contract or a shorter term contract. But the basis of mortgage lending is 4 times your allowable income for a first-time buyer, 3.5 times for a second-time buyer. And the big thing to be aware of is all lenders differ in terms of their credit policy. So each lender will offer you a different amount in the main, and particularly if you have variable income. So that's the loan to income rules, and that's how much you can borrow. And our team at Doddle will always be working with clients to understand what they need and how much we can allow them to borrow under different credit policy and also on the basis of exceptions. The second pillar of mortgage lending is loan to value rules. And this really is what deposit do you require? So for all purchasers, the deposit requirement is 10%. So that can come from savings, it can come from a gift, or for first-time buyers purchasing new build homes, you can avail of what's called the Help to Buy scheme. I'll talk about the Help to Buy scheme later and just the basis of it, but it really is a really useful and well-used, I suppose, facility for or scheme for first-time buyers purchasing new build homes. The cap on the purchase price to be eligible for this, the first home scheme, is 500,000, and you basically get a refund of the tax you paid over the last 4 years. This can be up to 10% of the purchase price, but it's capped at 30,000. There's also another scheme called the shared equity scheme or first home scheme, which is available again for first-time buyers purchasing new build homes. And it's designed to bridge the gap between the mortgage amount you're eligible for and the purchase price of the property you want to buy. So if we look at it, 10% deposits required. You can show that deposit via savings, via gift, or again, the first home scheme, the Help to Buy scheme can be taken into account as part of your 10% deposit requirement if you don't have that full 10% deposit. The third and really, I suppose, important pillar of mortgage lending is that you show clear evidence of repayment capacity. And what this means is the bank want to see, can you afford the proposed repayment? So they're going to look at your track record over the last 6 months immediately preceding the application. And they're going to say, if you want to borrow 400,000, for example, how can you show us that you can afford to repay that 400,000? So they look and they say, what will be ceasing after you draw down the mortgage? So it'll be rent, or what are you saving consistently? Or do you have education or personal loans that will be discontinuing? So they look at that and they say, okay, based on the last 6 months, you're showing us repayment ability for the proposed mortgage. As a broad rule of thumb, for every 100,000 that you want to borrow, I would suggest that you would show repayment ability of 500 euros per month. So in the case of a mortgage of 400,000, you'd need to show 2,000 euros per month repayment capacity based on rent, based on savings. And if it's a joint application, that could be jointly savings and rents. If you have a loan that's coming towards the end and you're making a repayment on that, and you feel that your repayment or your loan could be cleared or will be cleared prior to the drawdown of the mortgage, we can note that. And the monthly loan repayment can also be taken into account as your repayment ability. Some key points on that are: the one reason that an application can be deferred or declined, or that we won't submit to a lender and we'll advise you to go back and really just maybe take another 3 or 4 months to assess your repayment ability, is because sometimes it'll come to December or over the summer or wedding season, you may skip a month's savings. So it's so important that if you're going for a mortgage, that you make sure the 6 months immediately preceding your application, that you're really consistent with your savings, that you show your repayment capacity every single month. What the lenders will say is your mortgage has to be paid every month. So they won't take the excuse or the basis that you may have been on holidays, or you did a once in a lifetime trip, or you did, you had to, if you have to buy a car, or if you have exceptional costs, that's fine. But really try and be consistent with your monthly savings, or really try and ensure that you show that 6 months continuous repayment capacity. Banks look at account movement. So for example, if you got a deposit and in the particular 6 months before the application, you spent that deposit, discretionary spend, the banks will look at depletion on your account. So it's just to be really mindful in that 6 months immediately preceding application that you really think about your spend and your save, and that you're really strict as to showing that repayment capacity, because it will be something that the lenders need to see, and it can be something that really can impact your application. Once repayment capacity is proven, the banks don't necessarily look at your discretionary spend. So sometimes people think, I'm going to take cash out if I'm going for a night out or a shopping spree. That's not the case. Once you're showing your repayment ability, once you're consistent on your repayment, the banks know you spend, they know you have a lifestyle. So, you know, they're not looking to nitpick at your accounts once they can see that clear repayment ability. There's only one lender in the market, and there are new lenders to market, new and money, who do not look at repayment ability. So for all other lenders, you need to be mindful of your spend and save, because again, they may defer an application if they can't see that consistent saving and see that proven repayment ability. So again, the three main things: loan to income, your 4 times income multiple if you're a first time buyer, your 3.5 if you're a second time buyer, and also being mindful that lenders all differ in terms of the amount that you can borrow. The 10% deposit requirement is another key thing. You need to demonstrate how you will have that 10%, whether it's savings or gift, to fund the purchase of the property. And the third thing is that clear evidence of repayment capacity. So again, are the clear pillars for mortgage lending. When we submit a credit proposal for our clients to the mortgage lender of choice, we will cover off all of those bases. And once we're clear on all of those items and the bank understands where we're coming from, and we've proven what we need to prove, there's no reason why an application will not be approved successfully. So a big question that I get quite a lot is like, what's the best lender? And, you know, how can I choose the best lender? So the best lender can come down to a few different things. It can come down to the best rate on the market. So the lowest rate in the market is now 3%. It can come down to the looking at, for you, the happy marriage of the mortgage level you require, the interest rate that's available to you, and flexible benefits you might want, such as cashback offers, overpayment options, or deferred period. So there's no one best lender on the market, which is probably just as well, or I might be out of a job. So what we will always do is look at your needs and your requirements and try and find the best lender for you. Sometimes people might want an exception, and that might mean the lender that offers the maximum exception level on mortgage amount may not have the lowest rate, or the lender that might have a cashback offer may have a slightly higher rate. So it's trying to give you all the options so that you can make an informed decision as to what lender suits you best. And I suppose the benefit from where I stand is that we work with all major lenders, so we know what each will offer and can kind of build that proposal for you. So again, the best lender isn't easy to identify. You can identify the best rate quite readily, but oftentimes there'll be a difference between obviously the mortgage level you can borrow, the interest rate that's available, and the flexible benefits that are available. I think a big important thing to note is that there are now 12 lenders in the Irish market. So if you go to one lender, chances are you're missing out on what the best rates in terms might be for you. So my advice to anybody who's looking to get a mortgage is do your research or get market-based advice from a broker. Make sure you don't accept the first mortgage that's offered to you, because mortgage lenders differ greatly in terms of the amount you can borrow and the interest rates that are available. So I've broken every rule in the form of slide preparation here with all of these numbers and letters and figures. But I did this just so that when you're taking this as a handout, it's going to be distributed, that at least you'd have it to hand. So I just wanted to cover off what mortgage rates in Ireland are like at the moment, or when you're looking at different lenders, you might hear these different terms being called out. And so just so you're aware of them. So mortgage rates in Ireland are generally tiered based on mortgage level. Some lenders will offer lower rates if your mortgage is over 250,000. They're classed as high value mortgage rates. They're based on loan to value. So loan to value, or LTV, is another technical term that's used, but really what it means is your mortgage divided by the value of your property. So if you have a 10% deposit, you're at 90% loan to value. If you have a 20% deposit, you're at 80%, etc. Building energy rating is another one that determines the rate that some lenders will offer. So green rates are available for A and B BER rated homes. So any home that comes to the market will have a building energy rating. So it'll be advertised by the agent, and also new builds are all A rated homes. So green rates are some of the lowest on the market. And if you're purchasing a property with an A or B energy rated home, you should really be looking out for those green rates, because they offer quite a lot of value as compared to other lenders on the market. Different reasons, so different lenders will have cashback offers. So those cashback offers are where you get 2% of your mortgage back in cash 40 days after you draw down the mortgage. So one key thing I suppose to be aware of with cashback offers are that some lenders offer a higher rate with the cashback offer. There's often a thing that there's no such thing as a free lunch, and it can be the case that cashback offers are more expensive than the rate you can secure excluding a cashback offer. So just to be aware that these are the kind of 4 main areas as to how lenders tier their rates. So they look at the mortgage level, they look at the loan to value, they look at the building energy rating, and they also will have a premium in a lot of cases where there is a cashback attaching, especially the 2% cashback offers. So looking forward as to what to expect in 2020 in terms of mortgage rates. So over the last 2 years up to the end of 2022 or halfway through 2023, or 2024, rates had gone really high in 2022 as a result of ECB rate increases. So we had for the first time in 10 years, rates had increased quite a lot from a very low base. So this was kind of, I suppose, a shock to the market, in particular for people who had taken out a mortgage in the last 10 years. They'd been used to low rates, and the fact that rates rose so quickly through 2022 and 2023 was quite a shock. From the middle of 2024 onwards, rates started to decrease. So we're now in a kind of quite a good place with rates, where they're not as low as they once were, which were sub 2% pre-2022. They're now starting from 3%. But I would say the big thing about mortgage rates in Ireland is there's a huge disparity between rates. So while they start at 3%, they go right up to over 6%. So that's why it's so important to not just accept the first rate that's offered to you, because interest adds no value to your mortgage. The lower you can get that mortgage interest rate, the better, because the lower the cost of credit. So this year we expect to see the ECB to continue to cut their rates, but the ECB rate doesn't directly impact the fixed rates or the variable rates in Ireland. So today there was a new rate actually offered or issued by Avant Money, and it's actually a Euribor rate. So it's a rate that tracks the Euribor as a benchmark to the Euribor rate. So it's a new type of variable rate. The Euribor rate is what where the banks fund their monies to lend to mortgage customers. So while the ECB rate may decrease and continue to decrease over the coming months, I would say don't expect a corresponding decrease on the rates in the Irish market. Some lenders will certainly tweak rates, and those lenders that are up at that 6% mark have to come down. Like, their funding costs have dropped, so you'd expect those to drop. But I think more so in the Irish market, any lender that has a rate between 3 and 3.5% would possibly tweak those rates to remain competitive. So I think the big thing is, and the big call out is, make sure you do your research. There's such a disparity in rates across the market that, it's so important to select the lowest market rate that you can achieve for the requirements that you have in terms of mortgage amount, etc. Looking out at what else is required, we talked about the 10% deposit, but just to be aware that when you come to purchase a property, so when you go sale agreed on a property, you'll also need to take into consideration that there are other costs and fees incurred in transacting that purchase. So you'll have a valuation fee, which is roughly €200, a surveyor's fee, which, depending on the size of the property, is approximately €500, and you'll have your legal fees, which include the conveyancing of the property, so the transfer the title of the property to you. I would say budget €2,500 for your legal fees, again €500 for your surveyor's fees, and €200 for your valuation fee. Stamp duty is the big one that can sometimes catch people out, because stamp duty is 1% of the purchase price. So just to be aware, if you're purchasing a property and say it's a second-hand property for 400,000, you will have stamp duty of €4,000 to pay when you complete on the purchase of that property. So again, taking a €400,000 mortgage, you'll have 4,000 stamp duty, 2.5 for your legal fees, I would budget, and then 700 for your valuation and surveyor's fee. I would say, based on whatever your purchase price is, budget an extra 2% of the purchase price to cover these costs. I've just included a note there to say, at Doddle, we don't charge a fee. We get paid by the lender you choose to take your mortgage with, and it's the same payment regardless of the lender. So we are a no-fee broker. The monthly costs associated then with actually paying your mortgage, what else is there? So you'll have your monthly mortgage repayment, and as a really broad rule of thumb, based on rates at the moment, if you were to take a 3.5% rate over a 30-year term, for every 100,000 that you would borrow, you would have repayments of €450 per month. Again, that's a real back of the envelope type figure. We have all forms of rate and repayment calculators on our website that you can look at. But again, broad brush, for every 100,000 you want to borrow, 450 would be the repayment. So if you wanted to borrow 400,000, your repayments would be €1,800 per month. So that would be your monthly mortgage repayment. There are two different types of insurances that you require to have when you're drawing down your mortgage. One is life cover, sometimes referred to as mortgage protection, and the other is home insurance. So that's buildings insurance. So that because your home is the security for the bank, they will require you to have a policy in place that would pay out in the event that the property was damaged or demolished. On the life insurance side, or the life assurance side, the policy is designed to clear the mortgage in the event of death. There are other policies that are in place, like income protection policies, which are hugely valuable. But looking at bare bones cost of what you're required to have to draw down your mortgage, it will be your life cover or mortgage protection, and it will be a home insurance policy in place to cover the rebuild cost of the home should the home be destroyed. So when you're budgeting, just bear in mind the transaction cost to take out the mortgage. Add an extra 2% to the purchase price when you're looking at what that will cost you. So you have to have your 10% deposit and then roughly 2% of the purchase price saved as well to cover those additional transaction costs that will be required before you actually exchange and get your keys. The monthly costs will be your monthly mortgage repayments, your life assurance and mortgage protection premium, and that will be a monthly payment, and your home insurance policy to cover the rebuild cost if your property is damaged. So there are the general costs to take out the mortgage, and then monthly cost to transact as such. Looking at, and many of you might be first-time buyers, so I thought I'd just touch on the supports that are available for first-time buyers. Unfortunately, and for many of my clients, it's a frustrating point, these are generally available to first-time buyers who are purchasing new build properties only. So new build properties, not second-hand properties. The two main schemes are the Help to Buy, which I touched on earlier, but basically it's 10% of the purchase price max 30,000 as a rebate of the tax you've paid over the last 4 years. So if you've been in Ireland and you've paid tax over the last 4 years, this will be a rebate of that tax that you've paid. The First Home Scheme is also is for new build properties only. And so this was a government incentive that was designed to bridge the gap between the mortgage amount you're eligible for under central bank lending rules, so that's 4 times income multiple, and the purchase price of the property. The gap that can be bridged, or the equity that can be taken under the First Home Scheme, is up to 30% of the purchase price, or 20% if you're availing of the Help to Buy scheme. So no interest is paid on the equity portion for the first 5 years, and thereafter a service charge is paid. The equity piece that is granted under the First Home Scheme need only be repaid on sale of the property, on death, or if the property is no longer your main residence or you switch outside a lender of the scheme. So I know that that can be a little bit tricky. I also know that many of our first-time buyers have successfully used both the Help to Buy and the First Home Scheme to purchase their homes. So it is really important that you're aware of both of those schemes when it comes to, researching what your max purchase price is or what your limits are and the various different options that are available to you. I'm going to put up a slide that has a lot of figures on it, but again, it's for the purposes of taking it in your own time to look at it when the slides are distributed. So this slide is really just looking at if you were a single applicant and you had savings of 30,000, you had an income of 55, what's your purchasing power? So what could you afford under, with purchasing a second-hand property? What would be your upper limit budget? What could you afford then if you were to use the Help to Buy scheme to purchase a new build home? And what could you afford if you were to use the Help to Buy and the First Home Scheme? So you'll see throughout each of those columns, you'll see, the max purchase price for somebody if they were buying a second-hand home would be 220,000 based on their 261,250 based on a central bank exception up to 4.75 times income multiple. If we were to look at using the Help to Buy scheme and a first-time buyer, the potential home purchase price would be 320, or without an exception, 278. Looking at the First Home Scheme and the Help to Buy scheme, it could bring you up to potentially a purchase price without an exception of 310,000. So there's lots of options available. And what I would say is, please, if you are looking at purchasing a new build, make sure you're aware of both the Help to Buy scheme and also the First Home Scheme, because it really is a great scheme that's in place to help people get on the property ladder. We all know that new build homes in particular are so expensive right now that, you might need some of these supports, and they have worked really well with some of our clients. Our team would generally go through this type of a process with you and explain, okay, what your upper limit budget is without an exception, with an exception on a second-hand home. And then by using the schemes, what you could avail of and what would that bring your upper budget to. So what happens then when you go sale agreed? Sometimes we're always so focused on the approval in principle piece, but nobody comes to us to get approval in principle per se. They all want to buy a home. So what happens once you find that home when you go sale agreed? If you're purchasing a new built home, you will purchase generally from plans, and you will be able to put down a booking deposit, and that will secure the home for you. If you're purchasing like a second-hand home, they will often be sold in private treaty. And what that means is you'll undergo a bidding process. And if you're successful and you go sale agreed and you put your booking deposit down, you'll move from having your approval in principle to be now having a property and having details and understanding how much mortgage level you need, what the property purchase price is. We would be able to work then on really refining what lender of choice suits you best, what the best rates and terms are for you. And we get what's called a loan offer letter issued. So you move from approval in principle to loan offer. And loan offer really has is a legal document because it needs to be signed by you with your solicitor. It has the property, it has the purchase price, the lender, obviously, and it will have the rates and terms you select. So once you get your loan offer, you're in a position then to sign contracts. So initially, you just put down a booking deposit. And what that means is it takes the property off the market. It's not binding on you or the vendor who's selling the property or the developer until contracts are signed. And in order to sign contracts, you need a loan offer. So that's the second step in the process. The first is to get your approval in principle, to understand your budget and to allow you to house hunt. Once your sale agreed, you'll get a loan offer issued from your chosen lender that will allow you to sign contracts. And then at that point, we would start to work on all of the completion items, like such as the life cover and the home insurance that we discussed previously. Your mortgage lender will require direct debit, and you will work with your solicitor to close off on, I suppose, ensuring the title of the property is in order and signing contracts and making sure you're ready to go. You will then be set a closing date. So the closing date is the date that you get your keys. And before that, you need to draw down the mortgage from the lender. And our role at Doddle, or your mortgage advisor that you would work with, will guide you through that process, ensuring everything is in place from step 3, so that when you're due to close, we'll be able to release the funds from the mortgage lender and you'll be able to close out on the purchase and get your keys. So again, the stage of the process, without having a property in mind, you can just get your approval in principle. That again tells you what your budget is, because you can apply for a particular amount, or we can look for maximum approval that you will require. Then once you go sale agreed, you get your loan offer issued. So approval in principle, I should say, is valid for 6 months. If you don't find a property during that 6-month period, the approval will expire and you can apply again. If you do find a property, the approval in principle is superseded by this loan offer document, which in turn is valid for 6 months to allow you to complete out on the purchase. So there are the stages in the process. The main one being getting your approval in principle, so you know exactly where you stand. It sometimes focuses your mind as well. You know what your budget is, and it can really start to make things feel a little bit more real. It also allows you to go sale agreed in the property. So it allows you to start house hunting and really start looking at properties in earnest and refining where you want to live and, going to viewings, etc. So I just thought I'd cover off some specific items that I think are probably relevant in the market as it stands now. So we've kind of touched on the fact that new homes, all the schemes are available for new homes. The first time buyer, or the Help to Buy scheme, and the first home scheme are for new build homes. So, but the vast majority of properties in Ireland are second-hand homes, and many of these homes that come to the market need renovation. So I just thought it was worthwhile calling out that if you're approved for a mortgage of, say, 400,000, and you end up buying a property for 350,000, but it needs work, you can look to borrow the additional 50,000 or for the purposes of carrying out works to the property, provided the works add value. Or that can be at the time of purchase, or you can leave it, you can live in the property and say, okay, do you know what, it could benefit from a new kitchen, new bathroom, I want to build an extension, and you can go back and look for a mortgage top up. So I would always say, in the current market where it's so challenging to secure a home, your first home may not be your ideal dream home, but potentially you can do works to make it more suitable for family living or for your own preferences. So just to be aware again that second-hand homes that need work, you can finance that work via your mortgage, provided the works add value. So just to be aware of that, because again, the majority of homes purchased in Ireland are second-hand. If we're looking at then the lenders on the market, there are 12 lenders on the market. There is 250 mortgage rates in Ireland. They range from 3% to over 6%. They depend on your mortgage level, your loan to value, your building energy rating. So again, don't accept the first rate that's offered to you. Make sure you do your research, understand what rates are available to you, because interest adds no value to your mortgage. It's a pure cost. The other thing I would say is mortgages are long-term products, and there's a large cost of credit. When you get your mortgage loan offer, it'll state the amount you're borrowing and the total cost of credit. And that number is a big number, because it's basing it on the fact that that mortgage is going to be in place for 25, 30 years, etc. So Unfortunately, interest is a necessary evil. But one of the things that you can really do to try and reduce your overall cost of credit or the overall interest you pay is to try and overpay your mortgage. And I know that's not easy, in particular when you're settling into a property at the start, but just to be aware that it's something that's hugely beneficial if you can afford to do it. So if you get a bonus on an annual basis, if you've quarterly commission, if you've stock or shares and they're vesting, really think about whether you can afford to overpay that mortgage, because without getting too technical, the capital balance that's outstanding, the interest hits that every single month to determine how much in your repayment is interest and how much is capital. So the quicker you can get that overpay and get that capital balance down, the better. It really, really will reduce the overall cost of credit. And it might be an incentive to you to see how much less interest you'll have to pay if you do overpay. Some lenders allow overpayment while on fixed. All lenders allow overpayment while on variable. When you're on fixed, generally it's a fixed contract, so you pay a fixed amount each month. So you just need to check if you think you'll be able to overpay, or if you think you might have a gift or inheritance or whatever it might be coming to you. Just be mindful that you need to ask the question, am I allowed to overpay on this rate? And the final thing I would say, just in terms of other factors to be aware of, is when you take out a mortgage, it's so important that you review your rate on regular occasions. So we would have an awful lot of clients who would take their mortgage with us today, would take a 3-year fixed rate, for example, and come back to us in 3 years' time and say, okay, what's the market like now? What rate should I look at now? And we will determine whether their current mortgage lender still offers the best rate or whether there's a better rate on the market, because circumstances change. Your loan to value will hopefully go down as property prices increase and you'll have paid off the mortgage, some of the mortgage. You may want to reduce the term of the mortgage. You may want to take a top up to do home improvements. There's loads of different reasons why you might want to switch to a different lender. But just to be aware, as you're going through this, maybe taking out a mortgage for a first time, please do always look at your rates at regular intervals. Please do question whether it's the best rate you can get, because it can add such value. Again, if you can secure a lower rate but continue to make the same repayments maybe as you had been, then you can accelerate the repayment of the mortgage. But always question the rate. You guys are financial people. You will be very good at looking at interest rates and analytical items. So please do look at it and make sure when you draw down your mortgage that you're kind of disciplined enough to switch where it makes sense to do so. All lenders have switcher products. 7 lenders in the market, even those with the lowest rates, offer cashback options. So there's no cost to switch, and it's certainly worth the time to spend reviewing your rate and switching. So that's just something for down the line. I know the priority is to get your home in the first place, but that is something to be really, really conscious of. Make sure you can pay as little as possible on your mortgage. So they're just kind of, I suppose, 4 things that I think are worth calling out, particularly on the second-hand homes piece, because most of the mortgages in Ireland are drawn down for the purchase of second-hand homes, and many of those need work. There are lots of options on the market, a big disparity on rate, and also just being conscious of being able to overpaying if you are able to overpay, and also being conscious of the rate that you get throughout the term of your mortgage, because it can significantly impact the overall interest that you repay. So I know I've gone through a lot there, and it's been, in a short space of time, but I would say when you're in that research zone of understanding, what you're eligible for, what different rates are like, use resources that are available. We would have a huge amount of updates on our blog, on our Instagram page, which is dodl_.ie, and also throughout our website. So there's nothing like getting advice. Speak to an advisor. I would always say, if you're planning on making a mortgage application, speak to a mortgage advisor at least 6 months prior to making the application, so you understand how much you can borrow, you understand what potentially that would cost you, and you understand what you need to be really clear on to make a successful application, especially that clear evidence or repayment capacity piece. So important. So hopefully that has added some value, but no doubt you may have some questions and I'd be delighted to answer them. So anything you guys think of or want to run by me, now's your chance.
So Martina, as expected, we've had an influx of queries and questions come through the chat box, so we'll try and get through these as quick as possible. So the first one that you have is, do banks allow one-off spends which might come out of your savings? So for example, if you're paying for a wedding and saving for a house, would still have plenty. They're trying to say they want to be able to show that they're paying money off towards the wedding and saving for a house and showing they have enough of a deposit still.
Yep. So we would always look at that. Like, life comes in those cycles where it's either weddings or kids or whatever it might be that come at you at once. So I would always say just try and keep it as clear as possible, but we can certainly add back one-off costs. So wedding expenditure, or if you had to buy a car, or if there was something lump sum that was very much one-off, then absolutely we would look to add that back, and that would be taken into account.
Perfect. And then I think you might have touched on this, but there's no harm to repeat it for everybody. Is your rent taken into account as part of your ability to repay on your mortgage?
Absolutely, provided it's clear on your bank statement. So if you pay your rent in cash, that can be a little bit more challenging, but make sure your rent is either mandated on your account or is a standing order or is clearly labeled rent, and then there's no problem taking it into account.
And then there'll obviously be a couple of people on this call that will be non-nationals. So they're trying to say, how would that impact their application? Should they have to wait, to the finalize their kind of citizenship process before they start looking at buying a house?
No, if you have a stamp 1, stamp 4, whatever stamp that you have, you will, and you're in a permanent role, so you're in a role that, and complete your probation period, there's no need to wait. You will be able to progress with a mortgage application straight away once you have that stamp.
That's brilliant news. And then, so what is the difference between the valuation fee and the surveyor's fee?
Yep. So the valuation is really the bank saying, is this property worth what you're paying for it? So if you purchase a second-hand home for 500,000, the bank will send out one of their panel valuers to carry out an inspection to say, this property is 4 bedrooms, it is in X location, it's worth 500,000. And when they do that, what they're doing is they're looking and saying, well, what did other properties in the area sell for? And they look at comparatives. In general, unless you've gone totally wild, I haven't seen it for a long time since actually the crash. The value of a property on an open market transaction, the value of the property is what somebody's willing to pay for it. So in general, the purchase price is the value, but the bank get, I suppose, pictures of the property. They get an insight as to what the property and the condition of the property is. A bank doesn't always look for a structural survey. So the other item is the structural survey, and that's a structural engineer or surveyor going out and looking at the property itself and the structure of it. So is there cracking? Is there damp? Does the roof look like it's in good condition, etc.? And that's like a home buyer's report, probably more than the bank's report, but it just gives you the confidence that the property you're buying is in sound condition. And the bank will only look to see your structural survey if the property is over 100 years old, or if the valuer on his report or her report calls out that there's, the property isn't in great condition.
Perfect. So as expected, there's a couple of questions here in terms of the Help to Buy and the first home scheme.
Yeah.
So I'll kind of say them together. So one, is there a limit on the salary to qualify for these schemes? Do you have to pay back on the equity? And then is there, for these schemes, is it just on apartments or houses? How does that work?
Yeah, so there's no cap on income. So it's not like some of the affordable home schemes where there is a cap on income, but there is a cap on value. So for the Help to Buy scheme, the max value of the home has to be 500,000 for you to be eligible for it. So for example, if you were looking for a new build and it was 550,000, you wouldn't be entitled to the Help to Buy scheme 30,000 amount. So that's one thing. You have to have a minimum loan to value minimum loan to value of 70%. So you can't have more than a 30% deposit for the Help to Buy to apply. In terms of the first home scheme, so the Help to Buy is a refund of the tax you've paid. So there's no equity piece with that. You're granted that amount based on the tax you've paid previously. It's 10% of the purchase price, capped at 30,000. 500,000 is the max purchase price, 70% loan to value is the minimum loan to value amount. And that you get that amount, and provided you're living within that property for 5 years, that there's no clawback, there's no refund, there's no repayment of that Help to Buy scheme. But the stipulation of the 5 years is a firm one. So you have to live in the home for 5 years, or else there could be a clawback of that 30,000. The first home scheme is totally different in that it's designed to bridge the gap. So any of the equity piece, so up to 30% of the purchase price can be taken under the first home scheme, or 20% if you're availing of the Help to Buy scheme. That is repayable, but it's only repayable if you sell the property on death, if you move out of the property and it's a residential investment property. So just to be aware, that is repayable, but only in those circumstances. So unless you sell the home, unless on death, or that you, again, the property is no longer your principal private residence, you don't have to repay it. It's not like a mortgage, okay? So there's no monthly repayment. So there's nothing to repay in the first 5 years. And then after that, you pay a service charge, which starts from 1.25%. So what I would say about that is, as you guys maybe are moving along in your careers, your salaries start to increase. So while it mightn't be totally, you might be eligible for that mortgage level that you need now, and you're using this first home scheme to bridge that differential. If your salaries increase or you have lump sums, you can look to choose to buy back that equity position. So say, for example, you purchased a home for 400,000 and you took 30% equity under the first home scheme. The first home scheme DAC will be putting 120,000 into the purchase of your property. So you will always owe that 30% back. So if time moved on and you sold the house and in 5 years' time it was worth 500,000, you would have to pay 30% of 500,000 back. So that'd be 150,000. But at any time during that period, you can choose to rebuy or buy back that equity piece. So you could buy 5% of that equity piece back this year, 10% next year, etc. So while you don't have to repay it, you can choose to buy back the equity stake that the first home scheme DAC have in it. It's a very consumer friendly, I suppose, scheme because it's by the government and participating lenders. So the main pillar banks and the government have put this fund together. So again, there's no monthly repayment. There's that service charge after 5 years, and you can choose to pay it back, but you do not have to pay it back only if you sell the property on death, or again, if it's no longer principal residence. Don't know if I covered everything there.
I think you did. I'm sorry. We'll quick fire these questions because we keep getting loads in, which is absolutely brilliant. And if we can't answer them live in this session, we'll probably take them offline and send it back as a note to everybody. So in terms of deposits, is that amount refundable? What happens, if the bidding happens to fall through on the property?
Yeah, so your booking deposit is always refundable, right? Until you sign contracts. So when you go sale agreed in the property, whether you're buying it as a second-hand home or whether you're buying it and putting down a deposit with, estate agent and it's a new build property, the booking deposit is always refundable. If you change your mind or if something comes up in the survey, you definitely get that money back. So you would get a receipt from the estate agent and you would get that money refunded to you right up until you sign contracts. So when you sign contracts, when you have that loan offer, then that's binding. So the booking deposit and any further contract deposit you might pay at that time, would not be refundable if you decided you changed your mind and wanted to pull out. So that's why it's so important, particularly if you're buying a second-hand home, that you get that structural survey done. Because if you discovered, subsequent to signing contracts that there was an issue with the roof, you're contracted to purchase the property. The other thing I would say, just in relation to new builds, circumstances can change, and we kind of learned this through COVID, that things can change outside of your control. So if you're purchasing a new build home and there's a long lead-in time to completion, just make sure that your solicitor includes a subject to funding clause in the contract. So what that means is if for some unforeseen event you couldn't get the mortgage, you lost your job, you couldn't get life cover, whatever it is, then the contract is subject to funding and you wouldn't lose that deposit. It's particularly relevant, if the house isn't going to be ready for a year and you don't know, something outside your control could happen. So new build homes, cover yourself by having, if there's a long lead-in time, having a subject to funding clause in contract. For everybody else, when you sign contracts, it is binding and any deposits will not be refundable. But prior to signing contracts, do your due diligence, make sure you're happy, make sure it's the right decision for you. And if you're not happy to progress, don't sign that contract and get your deposit back.
Great advice there, Martina. So in terms of, we talked about the different stages in the mortgage process and that kind of approval and principal piece. So it lasts for 6 months, I believe. And if you want to get that extended beyond that period, what does that kind of look like? Is that hard to do? Do you have to justify it?
Yeah, I suppose you'll have the confidence that you can get approval. You'll know your credit check is fine. You'll know the bank are happy with your employment, etc. So if there's no change to your circumstances, it's quite straightforward. Some lenders just require 1 month's payslip and 1 month's bank statement. Other lenders will require full new application. But again, you'll have the confidence that you should be reapproved. The one thing I'd say is sometimes when people get their approval and they go, great, I have it, and then they don't buy anything for 4 or 6 months, and then they come back and they're like, oh, well, I kind of went on a big holiday idea, and you're not as mindful of your spend. Just be really conscious that until you go sale agreed, until you draw down your mortgage, you just have to be mindful that the bank can ask you for your bank statements and look to see if you're still showing repayment ability during that time. So be conscious that if you need to go back and get the approval, maintain your savings, make sure your rent is still evident, but it's generally not a big issue to get the reapproval back in place. And it happens, some of my clients will go sale agreed straight away. Others will take a year, 18 months. that does happen in the current market. And actually, they're the ones that you love when they do go sale agreed, because they've been trying for so long. So there's no problem if you need to get your approval, or if, for example, your circumstances change positively and you get a salary increase or something like that happens, we can go back and look for a higher approval level. If your circumstances change negatively, or one person has lost their job, or they've moved roles and they're on a probation period, make sure you let your mortgage advisor know that. We know a lot of things about people, their family circumstances changing, everything. And that's why it's important, because sometimes it doesn't impact your mortgage and sometimes it does. And it's just to be really clear, particularly if you're in that phase of you've signed contracts, you're committed to the purchase, you need to update your mortgage advisor. We're like your confession box in some way. You can tell us anything and we'll sort it out for you. So that's just really important, because a bank at any time, if your circumstances change negatively, can withdraw their offer. So you just need to be very conscious of that.
Great. So I think I'm going to wrap up with like two quick fire questions here around, I know you're talking about banks there. So one, isn't necessarily really to have like a current account or a deposit kind of savings account with the bank that you're going to go to. And then I think it's a really great question in terms of, so factoring in age, and, if you're over 40, is that a bad starting point to try and start looking at a mortgage?
No, so I think just on the first question, you can take your mortgage with any lender you choose. So if I bank with AIB, my Mortgage Bank of Ireland, it doesn't matter what lender you choose to take your mortgage with, you'll set up a direct debit. Some lenders do, actually just one really, Bank of Ireland have a mortgage saver account whereby they will give you a bonus on your interest. So as well as your interest, they'll give you a mortgage saver bonus if you take the mortgage project with them. But I suppose what you'll need to be mindful of is, do Bank of Ireland have the best rate in terms for you at that time? So that's really the only savings account that has an added bonus for people who have that mortgage saver Bank of Ireland and take their mortgage with Bank of Ireland. So, I think it's a good discipline to have a separate savings account. Get paid, mandate your savings out to it, don't touch it, right? That's always a good discipline, rather than letting your current account ratchet up, because sometimes that will have, ins and outs and debits and credits and the whole lot, right? So it's much cleaner to have that savings account, and don't look at it then, it's gone after payday. The second item, just in relation to age. So age, when you're going for a mortgage, right, you can generally borrow up to the age of 70. Okay, so age of expiry 70. Now, most people will never want, including myself, a mortgage until they're 70 years of age. So sometimes from an affordability point of view, you might go with the longer term and plan to make overpayments or bring the term back down in the near future. So what I would say is, if you are, if you're a first time buyer and you're in your 40s and you're thinking, you haven't got a massive deposit, or you're looking at options, the first home scheme to Help to Buy, absolutely for sure, if you're looking at new build properties. And then after that, again, the mortgage term, you may not want to take the mortgage term up to 70 years of age, but it does give you that flexibility, it reduces your repayments, and you can plan then to overpay as time progresses. But I would have, like myself in my late 40s, I would have plenty of clients who are coming to me, and their circumstances may have changed. They maybe have gone through a separation or a breakdown of a marriage or whatever it might be, and they're looking to see, how much they can borrow themselves and to start again. There's also, for anybody who's going through a separation and divorce, there's a fresh start principle. So if you do leave and have no interest in the family home, you're classed as a first-time buyer under central bank rules. So there's a few different things like that, but absolutely, I have many clients of all different ages looking to secure mortgages, and we will be able to advise on term, on how we can look to repay that mortgage before the expiry of before retirement really age. And that's the case for everybody. Everybody's looking to try and get their mortgage cleared as quickly as possible, and to pay as little interest as possible.
That's great, Martina. Thank you so much. Just to give people context, there was about at least over 30 questions, and that we were trying to quick fire as many of them as possible as we could. But we'll try to come back to everyone in the follow up with the slides. So again, Martina, thank you so much for this really brilliant and insightful session. You really took to desimplifying a lot of that kind of terminology around mortgages, looking to really explain that homework and lending process, and shared brilliant tips that all of us can take away with us. So thank you so much. On behalf of the ACA Professionals Committee, I want to thank everybody that has joined this call. There was over 170 of you who came on the session live. So we hope you find this session really invaluable. And as I said, we'll be sharing this slide deck and more information in the follow-up today. So enjoy the rest of your day, and thank you so much.